Welcome to the Deep Dive, the show where we really try to cut through all the noise and get straight to the core insights, the things you actually need to be well-informed.
Especially today, right? Things move so fast.
Exactly. And when you're looking at something as complex as financial markets, knowing how to quickly grasp what's going on with stock returns or investment strategies, it's not just nice to have, it feels absolutely crucial.
It really does.
But, the world is just awash with data. How do you filter out that endless noise? How do you get to what really matters?
Well, that's pretty much our mission for today. We're going to take a deep dive into a really exciting evolution in how financial experts analyze and predict stock returns.
Okay.
We're talking about the Q factor model, which is already a well-regarded framework. It's really shaped our understanding quite a bit.
Right, a big deal in the field.
A very big deal. And we're looking at a powerful new augmentation to it, something that could genuinely change how we understand market dynamics. It's called the expected growth factor.
Expected growth, okay.
And adding this leads to what's now known as the Q5 model. 5 factors instead of the original 4.
And we're not just pulling this out of thin air. We've got solid research to back this up, right?
Oh, absolutely. We're unpacking some meticulous research here from a paper called An Augmented Q Factor Model with Expected Growth. And there's a supplementary appendix, too, which is just packed with detail.
And who's behind this work?
It's a collaborative effort from some really sharp minds, Kiwei Ho, Haitao Mo, Chen Su, and Lu Zhang. They're representing top institutions like Ohio State, Louisiana State University, and the University of Cincinnati.
Solid credentials.
Definitely.
Yeah.
And this work is actually slated to appear in the Review of Finance, which is, a top-tier journal. So it's undergone rigorous peer review.
So our deep dive today, what's the main goal? What do we want you, the listener, to take away?
Our goal is really to give you a crystal clear understanding of the economic thinking, the intuition behind this new expected growth factor. We want to show you how these researchers painstakingly built it from real-world data. It wasn't easy.
I bet.
And most importantly, we want to see how this enhanced Q5 model actually performs. They put it through a really rigorous horse race against other leading financial models.
A horse race, I like that.
Yeah, and they really threw the kitchen sink at it. They tested it against a massive set of 150 real-world market anomalies, things that have puzzled researchers for years.
Wow, 150, that's comprehensive.
It really is.
Yeah.
So this isn't just about, dry academic theory. It's about giving you a sharper lens, a better tool for navigating and understanding the powerful forces that are shaping financial markets every day.
Absolutely. It's about making sense of what can feel like this overwhelming sea of numbers and theories. Okay, I'm ready. Let's unpack this.
Great.
So let's start at the foundation, the bedrock, as you called it, the original Q-factor model.
Right.
This model, introduced by Hu, Xu, and Zhang back in 2015, it's not just some abstract math, is it? It's grounded in real economic thinking.
That's exactly right. It's firmly rooted in what economists call a static investment framework.
Okay, static. What does that mean in practice? Like a snapshot?
Yeah, think of it exactly like a snapshot in time. It looks at a firm's investment decisions kind of as if they're happening right now, driven by a few key current considerations, not so much looking far into the future.
Got it. So what's the core idea driving those decisions in this static view?
The core idea is pretty intuitive, actually. If you just imagine being a manager at a company, you're deciding whether to invest in new projects, maybe build a new factory, develop a new product line, expand somewhere.
Right, big decisions.
Big decisions. And they hinge on 2 main things. First, how profitable do you expect those new projects to be? And second, what's your cost of capital?
Cost of capital, essentially what it costs to get the money for those projects.
Exactly. It's the discount rate you apply to those future profits, or the return your investors demand, or the interest on debt. How expensive is the money you need to fund the growth?
Okay, so let's make that concrete. Say a company has a great opportunity, build a new factory. If they expect really high profits from that factory, and maybe interest rates are low, their cost of capital is low, they're probably going to build it.
More likely, yes.
Right.
It's a pretty clear signal. Go ahead, invest. But flip that scenario.
Okay.
Same potential profits, but maybe the cost of capital is really high. Borrowing is expensive. Investors are demanding a huge return. Suddenly, those same projects, they just look less attractive. The hurdle rate is too high.
So the company invests less. Makes sense.
Precisely. And from this basic idea, the model points to 2 key drivers that help predict expected stock returns. The first one is investment to assets, or IA.
Investment assets. Okay.
Now, here's the interesting part. The model predicts that stocks of companies investing little relative to their existing assets, these should actually generate higher expected returns than companies investing a lot.
Okay, hold on. That sounds a bit backward. Why would investing less lead to higher expected returns? Usually we think growth is good, investment is good.
It does sound counterintuitive at first glance, but here's the key insight. If a company is investing very little, why might that be? Often, it's because its cost of capital is high.
Ah, the hurdle rate again.
Exactly. New projects just don't clear that high hurdle, so they don't invest. Now think like an investor. If you're putting your money into a company facing a high cost of capital, aren't you going to demand a higher expected return yourself?
Yeah, absolutely. I need to be compensated for that underlying, well, difficulty or risk or whatever is causing that high cost.
You got it. The market is implicitly saying, look, if you're not expanding much, it's probably because capital is expensive for you. So if I'm going to invest in you, I expect a better potential payout to make it worth my while.
Okay, that clicks. Low investment implies high cost of capital, which implies high required return from investors. Makes perfect sense now. What's the second driver?
The second driver is return on equity, or ROE, profitability.
ROE. Okay, that sounds more straightforward. High profitability, high returns.
Well, yes, but with a nuance connected to the first point. The model suggests that stocks with high expected profitability should earn higher expected returns than those with low expected profitability. But again, think about the interaction.
Ah, okay.
If a company is expected to be super profitable, but it's still not investing heavily, what does that tell you?
If the projects look good on paper, high ROE, but they're not doing them, maybe that cost of capital is really high again.
Exactly. A high discount rate must be at play. That high cost of capital is needed to push down the net present value of those otherwise attractive, high profitability projects, keeping current investment low. So the combination high expected profitability plus low current investment often signals a high cost of capital.
Which again leads to higher expected returns demanded by the market.
You've got it. It's the interplay that matters.
So it's not just about looking at profitability in isolation, but how it connects with the actual investment decisions the company is making. That paints a much richer picture.
It really does.
And these theoretical ideas, IA and ROE, they don't just stay theoretical, right?
Yeah.
The model translates them into practical factors you can measure.
Absolutely. These theoretical insights get operationalized. You look at actual company characteristics. The original Q-factor model uses 4 factors based on this.
Okay, what are the 4?
First, you have the standard market factor, RMKT. Captures overall market risk premium. Everyone includes that.
Right.
ADA.
Essentially, yes.
Then there's a size factor, RME. This accounts for the historical observation that smaller companies sometimes outperform larger ones, the size premium.
Okay, market and size. Standard stuff.
Pretty standard. And then the 2 specific to this theory. An investment factor, RIA, based on that investment to assets ratio we discussed.
Low investment, high return premium.
Right. And a return on equity factor, RO, based on profitability.
High profitability, high return premium, especially if investment is low.
Exactly. Those 4 factors, market, size, investment, RO, form the original, quite powerful Q-factor framework.
Now, this original model, it gained a lot of traction, well-deserved recognition, but it wasn't the final word, was it? It had some known limitations.
That's a crucial point to understand why the new research happened. Yes, despite its explanatory power, which was significant, the Q-factor model, robust as it was, it still left a lot of things unexplained.
Like what?
Market anomalies. These are patterns in stock returns that seem to defy traditional risk explanations. Things like the momentum effect or various accounting-based strategies.
Right, the things that keep finance academics busy.
Exactly. And the research showed that the original Q-factor model left a substantial number of these unexplained. Specifically, 52 out of a big list of 150 significant anomalies remained sort of outside its grasp.
52 out of 150 is quite a few.
It's a lot. It strongly suggested that, maybe a key piece of the puzzle was missing, something that its primarily static view, that snapshot view, wasn't capturing.
It needed something more dynamic, forward-looking.
Precisely. It needed a way to incorporate the future, not just the present.
And that leads us right into the breakthrough part of this research, identifying and then actually building this expected growth factor.
Yes, this is where it gets really interesting.
Because this moves beyond that static snapshot we talked about and looks at the future potential of a company.
Exactly. The researchers realized that if you look at dynamic investment theory, not just static, it suggests another powerful influence on expected returns.
Okay, what's the core idea there?
Here's the logic. Hold a firm's current investment level constant and hold its expected profitability constant. Now, consider its expected investment to assets growth. The theory suggests this expected future growth should also positively influence its current expected returns.
Okay, let me make sure I get that. So if a company is expected to ramp up its investment significantly down the road, that expectation alone should mean its stock offers a higher expected return today.
That's the idea.
How does that work? What's the mechanism?
You can think about it using a kind of capital gain analogy for the firm's projects. The value generated by a firm's investments, that sort of internal capital gain, is roughly proportional to its expected future investment growth.
Okay.
Now, the intuition is a bit subtle, but it's powerful. If a firm anticipates making big, valuable investments in the future, it implies that the marginal benefit of investing right now must also be quite high. Those future opportunities make even current investments seem more valuable down the line.
Right, because they set the stage for that future growth.
Exactly. So to keep the firm's current investment decision optimal, to prevent it from overinvesting today, just because the future looks so bright, you need something to offset that high expected future benefit.
And that offset is?
A high discount rate. Or, from an investor's perspective, a high expected return. This high expected return demanded by the market today acts as a counterweight to the high value of those anticipated future projects.
So the market is essentially pricing in that future growth potential right now by demanding a higher return today.
That's a great way to put it. It's demanding a premium now for that anticipated future growth.
That's a really cool insight, but it leads straight to the big problem, expected growth. You can't just look that up on a financial statement. It's inherently unobservable. It lives in forecasts and expectations.
Absolutely. That was the central challenge. How do you measure something that's fundamentally about the future and exists only in expectations?
So how did they tackle that? How did they actually go about crafting these forecasts for expected growth? What were they aiming to predict?
They needed a robust methodology, for sure. Their forecasting target was very specific. They focused on predicting future changes in investment to assets. They denoted DSIA, where that could be 1, 2, or 3 years into the future.
Why changes in IA, not just the level or the growth rate?
That's a clever choice. Trying to predict growth rates can get messy at the firm level. You can have negative investment, denominators near zero. It causes statistical headaches. Focusing on the change in the IA ratio avoids these issues, giving them a cleaner, more stable target to predict.
Makes sense. Keep the data usable. And the method they used to predict these changes. You mentioned Fama Macbeth.
Yes, they used a workhorse technique in empirical finance, monthly Fama Macbeth, cross-sectional predictive regressions.
Okay, break that down a bit. What does it let them do?
Think of it like this. Every month, they run a regression across all the companies in their sample. They're trying to see how various company characteristics today predict that future change in investment to assets, DSIA, 1, 2, or 3 years down the line. Then they average the results of these monthly regressions over time.
So it identifies predictors that consistently work across companies and over time.
Exactly. And they were careful about the details. They used weighted least squares regressions, using market equity as the weight.
Why weight by market cap?
That helps control for the influence of tiny microcap stocks. Those can have really volatile data, and you don't want them driving your results. This gives more influence to the larger, more stable firms, which is pretty standard practice.
Good thinking. Any other data cleanup?
Yes, they also tackled outliers. Both the thing they were predicting, future DSIA, and the predictors themselves were Windsorized each month at the 1st and 99th percentiles.
Windsorized, meaning?
It's a statistical technique. You basically cap extreme values. Anything below the 1st percentile gets set to the 1st percentile value, and anything above the 99th gets set to the 99th. It just stops a few crazy outliers from messing up the whole regression. Ensures the model is robust.
Okay, so careful data handling. How did they make sure the model wasn't just stuck in the past? Did it adapt?
Yes, it needed to adapt. They estimated the average slope, the predictive power of each characteristic, using a rolling window of the previous 120 months. That's 10 years of data.
A rolling window, so it updates every month based on the last 10 years.
Exactly, with a minimum requirement of 30 months of data to start. This allows the model to learn from history, but also to adapt gradually as market relationships potentially change over time. It's not using relationships from the 1970s to predict things in the 2010s without adjustment.
That sounds like a really solid adaptive approach. Okay, the crucial question. What were the key predictors? What inputs did they feed into this Fama Macbeth machine to forecast expected growth?
They zeroed in on three main predictors that had strong economic backing and predictive power. The first is Tobin's Q, specifically the logarithm of Q log.
Tobin's Q, we hear that a lot. Remind us what it captures.
It's basically a firm's market value, market cap plus debt divided by the replacement cost of its assets, usually proxied by book assets. So market value scaled by assets.
And the intuition?
The intuition, going back to economists like Keynes and Tobin, is pretty straightforward. A firm should invest more if its market value, average Q, is higher than the cost of replacing its assets, which is implicitly 1 in this ratio. A high Q suggests the market sees valuable growth opportunities, giving the firm an incentive to invest.
Okay, so Tobin's Q signals investment opportunities. Makes sense. What's predictor number 2?
Predictor number 2 is absolutely critical, and it's called operating cash flows, or COP.
Operating cash flows. That sounds important, given our earlier chat about internal funds for investment.
It's huge. And the way they measure it is very deliberate. Think of COP as the pure, unadulterated cash the company generates that's available for future investment, but adjusted to paint a more realistic picture of future potential, especially regarding intangibles.
How is it calculated? What goes into it?
It starts with total revenue, subtracts the usual stuff like cost of goods sold, COGS, and selling, general, and administrative SG&A expenses. But then, crucially, it adds back research and development expenses.
Adds back R&D. Interesting. Why?
That's one of the key insights. We'll come back to that. It also adjusts for changes in working capital accounts, receivables, inventory, payables, deferred revenue, etc. Things that affect cash flow but not earnings directly. And it's all scaled by book assets, like Tobin's Q.
Okay, so that addition of R&D, what's the deep economic reason for that? It seems counterintuitive to add back an expense.
It is counterintuitive if you only think about current accounting rules. But think about the economic reality. High operating cash flow, in general, obviously means more internal funds available for investment. That leads directly to higher expected growth, right? More fuel for the engine.
Sure, that part's clear.
But the R&D piece addresses a major challenge with modern companies and accounting. Intangible investments. Things like R&D, software development, maybe even brand building through advertising. Current accounting standards usually force companies to expense these immediately.
Right, they hit the income statement right away, reducing reported profits.
Exactly. This makes current reported earnings a potentially terrible indicator of a company's true future growth potential, especially for innovative companies. A firm could be spending heavily on R&D, depressing its current earnings, but actually building huge intangible value for the future.
Ah, so by adding R&D back into this cash flow measure, COP, they're trying to capture the investment aspect of R&D, not just the expense aspect.
Precisely. COP, by including R&D and focusing on cash generation before these non-cash charges or investments, provides a much better signal of the firm's capacity for future growth, even if its current reported earnings look weak. It sees the planting of seeds for future harvests, not just the cost of the seeds today.
That's a brilliant way to handle the intangible investment problem, a much more realistic picture of long-term potential. Okay, fantastic insight there. What's the third predictor?
The third predictor is the change in return on equity, denoted ROE.
Change in row. So how profitability is trending.
Exactly. It's simply the current row minus the row from 4 quarters ago. This captures more short-term dynamics. The idea is that firms seeing recent increases in profitability are likely to boost their future investments, and vice versa. It reflects how companies react and adapt to recent performance shifts.
So you have a measure of market valuation and opportunities, Tobin's Q, a measure of internal funding capacity adjusted for intangibles, COP, and a measure of recent performance trends, DRO. That sounds like a powerful combination.
They hope so.
How did they actually perform when put together in those Fama-Macbeth regressions? Did they significantly predict future investment changes?
Yes. When combined, these three predictors really did significantly improve the forecasting power. Looking at the one-year-ahead forecasts, that COP slope, the coefficient on operating cash flow, it remained large and highly statistically significant, which really underscores its importance.
So COP was a major driver. What about the others?
Log Q, Tobin's Q, actually showed a weekly negative slope in the combined regression, which is interesting. It suggests that while Q might indicate the level of investment opportunities, its power to predict the change in investment growth over the next year is less direct once you account for the strong cash flow signal from COP and the trend from DRO.
Okay. And DRO.
DRO, the change in profitability, was also statistically significant, so it confirmed its role in capturing those important short-term dynamics.
And overall, how much of the future variation did the model explain? You mentioned R squared.
Right, the in-sample R squared, which measures how much of the variation in future investment changes the model explains within the data used to build it. It jumped to a respectable 6.4% for the one-year horizon, and it got even better further out, reaching 9% for the three-year horizon.
So the model got better at predicting further into the future.
It seems so, at least in terms of explaining the variation within their sample. It suggests these predictors capture trends that unfold over multiple years.
Okay, in-sample is one thing, but the real acid test is out-of-sample performance, right? Using the model to predict on data it hasn't seen before.
Absolutely critical. You need to know if the model just memorized the past or actually learned generalizable relationships.
And how did it do out-of-sample?
It held up well. For the one-year horizon forecasts, the out-of-sample Pearson correlation was 0.14, and the rank correlation, Spearman, was 0.21. Both of those numbers were highly statistically significant.
So positive and significant correlations. That means the forecasts were genuinely predictive.
Yes. It validates the forecasting approach. It shows it wasn't just overfitting the historical data. It was capturing real, predictive relationships that held up when applied to new, unseen data periods. That gives you confidence that the expected growth measure isn't just noise.
Okay, so they've successfully built a predictive measure of expected growth. How did they then turn this into the actual expected growth factor, the reg factor that goes into the Q5 model?
First, they wanted to see if there was actually a return premium associated with this predicted growth. Does betting on high expected growth firms pay off?
Did.
Yes. They sorted stocks into 10 groups, deciles, based on their predicted investment to assets changes. And they found a robust expected growth premium.
Meaning the high expected growth stocks outperform the low ones.
Significantly. The high minus low decile, the return difference between the top 10% and bottom 10% based on expected growth, earned an average of 1.07% per month. And that was highly statistically reliable, with a t-statistic of 6.48.
Wow, over 1% per month is a huge premium.
It's very substantial, and it actually increased slightly to about 1.18% per month when they looked at the 2-year and 3-year ahead forecasts. So it seems persistent.
Okay, that's a strong premium. But the key question is, could the original Q-factor model explain this premium, or was it something new?
That's the critical test, and the answer was clear. The original Q-factor model could not explain this premium.
Really?
When they ran the high minus low expected growth portfolio returns through the original 4-factor Q model, it still left a large unexplained alpha of 0.86% per month. And this alpha was also highly statistically significant, T6.19.
Alpha meaning the unexplained part.
Exactly. It's the excess return the model can't account for with its existing factors. A big significant alpha like that is a smoking gun. It tells you the model is missing something important.
So this expected growth measure was clearly capturing a new dimension of expected returns that the original Q factors missed.
Precisely. It was identifying a source of predictable returns that was previously unaccounted for by that framework.
Now, one more check. Did the expected growth forecasts actually line up with what really happened later? Did the high expected growth firms actually grow their investment more?
Another vital validation point. And yes, reassuringly, the expected changes in investment assets tracked these subsequently realized changes pretty closely, especially when aggregated at the portfolio level.
How close?
For example, looking at the one-year horizon decile portfolios, the expected changes ranged from about negative 15% to plus 7.7% per year across the deciles. The realized changes over the next year ranged from about negative 17% to plus 6%. Very similar patterns.
And the correlation?
The correlation between the expected and realized changes across these portfolios was a strong 0.64.
That's quite high. What does that tell you?
It validates their empirical specification. It shows that while predicting growth for any individual firm perfectly is impossible, there are always firm-specific surprises. Their forecasting model was, on average, unbiased. The firm-level prediction errors seemed to diversify away when you looked at portfolios. The aggregate signal was reliable. Their forecast was genuinely capturing future reality for groups of firms.
That's powerful confirmation. Okay, so they have a validated predictor. It generates a premium the old model can't explain, and it lines up with reality. How do they construct the reg factor itself for use in regressions?
They use the standard methodology, very similar to how Fama and French build their factors to ensure comparability. It involves an independent 2 by 3 sort.
2 by 3 sort, meaning?
First, every month, they split all the stocks into 2 groups based on size,
Hmm?
small and big, using the median market cap on the NYSE as the breakpoint.
Okay, size split first.
Then, independently of size, they sort all stocks into 3 groups based on their predicted 1 year ahead investment to assets changes, DSIA. They use NYSE breakpoints again. The bottom 30% are low expected growth, the middle 40% are medium, and the top 30% are high.
So you get 6 portfolios in total: small low, small medium, small high, big low, big medium, big high.
Exactly. 6 value-weighted portfolios formed at the intersection of size and expected growth.
And how is the reg factor calculated from those?
Reg is simply the difference between the average return of the 2 high expected growth portfolios, small high and big high, and the average return of the 2 low expected growth portfolios, small low and big low. It's a high minus low factor designed to capture that expected growth premium across both small and big stocks.
Got it. Standard factor construction. And what did this reg factor look like once they built it? Did it have a strong average return on its own?
Oh yes. Looking at the data from January 1967 to December 2018, the reg factor had an impressive average return of 0.84% per month.
That's even higher than the simple high minus low decile you mentioned earlier.
Slightly, yes, likely due to the specific construction method. And this 0.84% was highly statistically significant with a t-statistic over 10, so a very robust finding.
And crucially, what was its alpha when tested against the original Q factor model? Did it still represent something new?
Yes, its alpha within the original 4-factor Q model was a substantial 0.67% per month, also with a very high t-statistic around 9.75. This confirmed, again, that reg represents a new, previously unexplained dimension of average returns. It wasn't just repackaging the existing factors.
You mentioned earlier that operating cash flow COP was a key predictor. Did its influence show up strongly in the reg factor itself?
Absolutely. When they did further analysis, they found that COF was arguably the most significant driver behind reg. If they created a factor based purely on COP and added that to the original Q factor model, it significantly reduced reg's alpha, dropping it from 0.67% down to about 0.37%.
So a big chunk of the expected growth premium is really driven by that carefully measured operating cash flow.
It seems so. It highlights just how important tracking cash generation, especially adjusted for R&D, is for understanding future growth expectations and the associated returns.
And how did reg correlate with the other factors in the original Q model? Was it totally independent or related?
It showed some interesting correlations. It was positively correlated with the investment factor, RIA, and the row factor, RRO, with correlations of 0.34 and 0.51, respectively.
That makes intuitive sense. Higher expected growth might go along with higher investment and profitability.
Right, but it was negatively correlated with the market factor, negative 0.46, and the size factor, negative 0.37.
Negative correlation with the market. That's interesting.
It is. These mixed correlations suggest that reg is indeed capturing unique market dynamics. It's related to investment and profitability, as expected by the theory, but it's definitely not just a proxy for market risk or the size effect. It's bringing something new to the table.
It's clear this expected growth factor is a powerful concept, but you emphasize that expected growth is unobservable. So the factor's construction depends heavily on the chosen predictors Q, COP-G-Row, and that Fama-Macbeth method. How sensitive were the results to these specific choices? Did they explore alternatives?
That's a critical question for any empirical work like this, and they did address it with robustness checks. They acknowledged that the factor being based on forecasts is dependent on the specific model used to generate those forecasts.
So what happened when they tried a simpler approach?
They created alternative expected growth factor by just taking an equal weighted average of the percentile ranks of log Q, COP, and DRO for each stock. Much simpler. No complex regression needed.
And how did that simpler factor perform?
It still earned a significant premium, 0.86% per month, very similar to the main reg factor. However, when they tested this simpler factor within the context of the final Q5 model, the one using the main reg factor, its alpha became small and statistically insignificant, 0.12% to 1.75.
So the main reg factor essentially subsumed the simpler one.
Exactly. It suggests that the more sophisticated Fama-Macbeth forecasting approach, using the estimated regression slopes, captured richer, more precise information about expected growth than the simple composite score did. The methodology mattered.
That validates their more complex approach. Did they try forecasting slightly different things, like overall asset growth instead of investment to assets changes?
They did. They tried forecasting the log growth rate of gross asset growth, which is another common way to measure investment. The results were largely similar. The factor derived from this alternative forecast target had an extremely high correlation, 0.99, with their benchmark reg factor.
So the core concept wasn't overly sensitive to the exact definition of growth they used.
It seems not. They also experimented with adding other potential predictors into their forecasting regression, things like past investment growth itself or variables suggested by other economic models.
Did that change things much?
It slightly affected the estimated expected growth premium, as you'd expect when changing the model. But reg, constructed using their main three predictors, consistently remained a significant factor explaining returns. It confirmed the robustness of the core idea, while also illustrating that, yes, the precise specification of any empirical model will have some impact on the exact numbers, but the main story held.
Okay, so it seems like they built a robust, well-validated new factor representing expected growth. This leads us to the Q5 model.
Exactly. The Q5 model is conceptually simple. It's the original Q factor model plus this new reg factor.
So the 5 factors are
The 5 factors describing expected excess returns are now the market factor, RMKT, the size factor, RME, an investment factor, RIA, the return on equity factor, RO, and this new expected growth factor, RED.
a 5-factor model aiming for a more complete picture.
A more comprehensive and dynamic picture, yes.
And presumably the first thing they checked was whether this new Q5 model could explain the returns of those expected growth deciles that the reg factor was built from. It should, right, for internal consistency.
Absolutely. That's a fundamental sanity check. And yes, as expected, the rug factor within the Q5 model effectively explained the returns of those portfolios sorted on expected investment to assets changes.
How effectively? What happened to the alpha?
The high minus low alpha for those expected growth deciles, which was large and significant in the original Q model, dropped dramatically to become statistically insignificant, negative 0.15%, T-Nesh and 1.5, within the Q5 model.
And why did it drop so much?
Because those high minus low portfolios had a very strong loading, a strong sensitivity to the new reg factor itself. The loading was about 1.5. The factor was doing exactly the job it was designed for, capturing that specific dimension of returns related to expected growth, leaving little unexplained for those particular portfolios. That internal consistency builds confidence.
Okay, the model is internally consistent. But now for the main event, the ultimate test you mentioned earlier, the horse race.
This is where it gets really compelling.
They didn't just compare Q5 to the original Q model. They pitted it against a whole stable of other leading factor models head-to-head against that massive set of 150 real-world market anomalies.
Exactly. This wasn't just about showing improvement over their own prior work. It was about showing how it stacks up against the best alternative explanations out there across the broadest possible range of challenges.
Remind us of the scope of those anomalies. 150 is a lot. What kinds of things were included?
It was incredibly comprehensive, covering pretty much all the major categories discussed in the literature from January 1967 to December 2018. They grouped them into momentum, 39 anomalies, value versus growth, 15, investment, 26, profitability, 40, intangibles, 27, and a few related to trading frictions, 3. So a really diverse set, testing the models from multiple angles.
And the contenders. Who is Q5 racing against?
Besides the original Q-factor model, they included several heavyweights. The Fama-Crinch 5-factor model from 2015, FF5.
The one with market size, value, profitability, and investment factors.
Right. Then the Fama-French 6-factor model from 2018, FF6, which adds a momentum factor, UMD, to FF5.
Okay.
They also tested an alternative Fama-French 6-factor model, FF6C, that uses a cash-based profitability measure, RMWC, instead of the standard RMW.
Trying different profitability flavors.
Exactly. Then there was the Barilla-Shanken 6-factor model from 2018, BS6, which includes market, size, investment, row, momentum, and a specific post-earnings announcement drift factor.
Another 6-factor competitor.
Yes. And the Standby UN 4-factor model from 2017, SY4, which focuses on mispricing factors. Plus the Daniel Hirschleifer-Son 3-factor model from 2019, DHS, based on financing and investment factors. A real who's who of modern factor models.
That's a serious lineup. And you mentioned they were careful about making it a fair race. Apples with apples.
Very important point. They noted that the original Standby Yuan and Daniel Hirschleifer-Son models were constructed using slightly different methods than the standard Fama-French approach, for example, different portfolio weighting schemes. To ensure a truly fair comparison, They replicated the SY4 and DHS factors using the standard, widely accepted Fama-French methodology.
So, same construction rules for everyone being compared directly on the anomaly tests. That ensures the results aren't just due to weird implementation choices.
Exactly. It levels the playing field for the main comparison.
Okay, so we have the track, 150 anomalies, and the horses, Q5 and its competitors. How did they score the race? What were the key performance metrics?
They looked at several things to judge how well each model explained the anomalies. First, the average magnitude of the high minus low alphas across all 150 anomalies. Remember, alpha is the unexplained return. So a lower average absolute alpha means the model is explaining more, leaving less mystery. You want this number small.
Low average unexplained return. Got it.
Second, the number of statistically significant high minus low alphas. How many anomalies did the model fail to explain, even after accounting for its factors? They looked at thresholds for significance, key stats above 1.96, and a stricter threshold of 3. Again, fewer significant alphas is better.
Fewer outright failures. Makes sense.
Third, the mean absolute alpha across all decile portfolios, not just high minus low. This gives a broader sense of model fit across the entire spectrum of each anomaly. Lower is better.
Okay, overall fit.
And finally, the number of rejections by the Givens, Ross, and Shanken GRS test. This is a formal statistical test that asks whether a model's factors can jointly explain the returns of a set of test portfolios, like the anomaly deciles. Fewer rejections by the GRS test indicate a better overall model performance across groups of assets.
So multiple angles. Average unexplained return, number of unexplained anomalies, overall fit, and joint explanatory power. Comprehensive evaluation.
Very comprehensive.
Before diving into the main results table, they looked at Sharpe ratios too, right? Measuring risk-adjusted returns for the factors and models.
Yes, that provides context on the factors themselves. Looking at individual factors, the new expected growth factor, REG, actually had the highest individual Sharpe ratio of all the factors considered, at 0.44.
Higher than momentum or value factor?
Higher than the standard momentum, UMD, or value HML factors, and also higher than the P factor, 0.32, used in the Barilla-Shanken model, which was second highest. It suggests REG offers a very attractive risk-reward profile on its own.
Interesting. And how did the original Q factor components compare to Fama-French's versions?
The Q factor's investment factor, RIA, had a higher Sharpe ratio, 0.20, than Fama-French's investment factor, CMA, at 0.15, and the Q factor's rho factor, RO at 0.22, outperformed both Fama-French's standard profitability factor, RMW, at 0.13, and their cash-based version, RMWC, at 0.19.
So the original Q factor components were already quite strong in terms of risk-adjusted performance compared to the Fama-French alternatives.
It seems so, based on this metric.
And what about the maximum Sharpe ratio achievable by combining the factors within each model? Which model offered the best overall risk-adjusted potential?
Here again, the Q5 model came out on top. It demonstrated the highest maximum Sharpe ratio at 0.63 among all the models tested. This suggests that its 5 factors, when optimally combined, offered the best potential risk-adjusted return for investors theoretically.
Better than the 6-factor model.
Better than FF6 and BS6 in this regard, yes. Interestingly, the Barilla-Shanken BS6 model had a higher maximum Sharpe ratio than the original 4-factor Q model, but as we'll see, its overall performance in explaining the 150 anomalies was actually poorer.
So a high Sharpe ratio for the factors doesn't automatically guarantee the model will explain everything well. You need the horse race results.
Exactly. A high Sharpe ratio is nice, but explanatory power across a wide range of anomalies is a different, arguably more important, test of a model's completeness.
Okay, let's get to that main event then. Table 6 in the paper, panel A. The overall performance across all 150 anomalies. Who won the horse race?
The results were pretty clear-cut. The Q5 model emerged as the undisputed best performer across the board.
How so? Let's see the numbers. Average unexplained alpha.
Lowest for Q5. Its average absolute high minus low alpha was just 0.19% per month. Compare that to 0.28% for the original Q model, 0.30% for the Fama-French 6-factor model, FF6, and 0.37% for the Daniel Hirschleifer Sun model, DHS. Q5 left the least unexplained return, on average.
Significant improvement there. What about the number of anomalies it failed to explain, the significant alphas?
Again, Q5 was lowest. It had only 23 significant high minus low alphas, using the standard T-stat equals 1.96 threshold. That's a massive reduction from the 52 unexplained anomalies for the original Q model.
Wow, more than half the number of puzzles. How did the others compare?
FF6, despite having 6 factors, including momentum, still had 74 significant alphas. So Q5 performed much better with only 5 factors.
And using the stricter significance threshold, T-stat 3.
Even more dramatic.
Yeah.
Q5 had only 6 alphas that significant. The original Q model had 25 and FF6 had 37. Q5 really nailed down most of the anomalies.
That's incredibly impressive. What about the GRS test, the joint explanatory power?
Lowest number of rejections for Q5 again. It was rejected by the GRS test for only 57 out of the 150 anomalies. That's way down from 101 rejections for the original Q model, and far better than the Barilla-Shanken model, BS6, which had the most rejections at 132.
So Q5 was much better at explaining the overall pattern of returns for groups of anomaly stocks.
Much better.
So putting it all together, the Q5 model didn't just improve on the original Q model. It substantially outperformed the other leading multi-factor models in explaining this huge set of anomalies, and it did this with just one extra factor, Reg.
That's the key takeaway. It achieved a remarkable dimension reduction. It took this complex space of 150 anomalies and showed that adding just one carefully constructed factor, expected growth, could explain a huge chunk of them, reducing the number of significant unexplained puzzles from 52 down to 23. That's making the world seem a lot simpler, in a good way.
It's like finding a unifying principle. Did the superior performance hold up across different types of anomalies, or was it just good at one thing?
It was broadly superior, looking at the different categories. In momentum, which is notoriously tough, Q5 showed noteworthy improvement over the original Q model, reducing significant alphas and GRS rejections. Interestingly, other models like FF6, even with the standard momentum factor, UMD, actually struggled more than Q5 in some momentum subcategories.
So Q5 handles momentum better than even models explicitly, including a momentum factor. That's surprising.
It is, and suggests the Q5 factors, investment, ROE, and expected growth, capture some underlying economic drivers that also relate to momentum patterns.
What about value versus growth? That's FAMA French territory.
Here, the Q and Q5 models performed well and quite similarly. The FAMA French 5-factor model, FF5, was actually the strongest performer in this specific category, which isn't too surprising given its HML factor is designed for this.
So FF5 still holds its own on value.
On pure value benchmarks, yes. But interestingly, the Barilla-Shanken model, BS6, did quite poorly here. The paper suggests this was partly due to a high negative correlation between its specific monthly value factor and its momentum factor, causing interactions that sometimes led to overshooting the explanation.
Yeah.
And the Daniel Hirschleifer-Son model, DHS, performed very poorly on value, actually making the anomalies appear larger.
A cautionary tale that more factors aren't always better if they interact badly.
Absolutely. Now, in the investment category, Q5 was the clear winner. It slashed the number of significant alphas down to just 1, from 9 in the original Q model, and cut GRS rejections from 19 down to 6. Huge improvement.
Dominant on investment anomalies and profitability.
Same story. Q5 led the pack again in the profitability category, significantly reducing unexplained alphas and GRS rejections compared to all other models.
What about the newer categories, intangibles and trading frictions?
Q5 was also the best performer in the intangibles category, which is important given the role of R&D in the comp measure. And in trading frictions, it was largely comparable to the other top models, except DHS, which again struggled. The overall picture is one of consistent, broad-based superiority.
To really summarize the overall picture, they also looked at composite anomalies, right? Combining scores across anomalies.
Yes, a very useful summary. They created deciles based on composite scores first, across all 150 anomalies combined, and then within each major category.
And how did Q5 do against the overall composite of all 150?
The high minus low decile for this overall composite earned a massive 1.69% per month, showing the combined power of these anomalies. Against this, the Q5 model had the lowest high minus low alpha, 0.37% T equal 2.62. Still marginally significant, but much lower than any other model. It also had the lowest mean absolute alpha across all deciles, 0.1%. Clear winner overall.
What about the composite for the really tough categories, like momentum?
For composite momentum, the Q5 model produced a high minus low alpha that was statistically insignificant. Natal dynamis 0.25%. T yield made up of 0.85. And importantly, the Q5 model was not rejected by the GRS test for this composite momentum category. That's a major achievement.
Wow, taming composite momentum, that's big. And investment and profitability composite.
Q5 was also the best performer for both composite investment and composite profitability. In both cases, it produced insignificant high minus low alphas and was not rejected by the GRS test. This really cements its status as the most comprehensive model in the horse race, able to handle these major anomaly dimensions collectively.
Okay, the horse race results are compelling. Q5 seems superior overall. Now let's get into the why. Can we look at some specific anomalies where the original Q model struggled and see how the Q5 model, particularly the reg factor, helps explain them? Table 8 delves into this, right?
Exactly. This is where we connect the factor back to the economics of specific anomalies. Let's start with one that remains a challenge. Momentum, specifically post-earnings announcement drift, PE, often denoted ABRA.
Earnings drift stocks keep moving after earnings surprises.
Right. Even the powerful Q5 model, like the other models, found it hard to fully explain this, particularly the very short-term drift, like over the first month after the announcement, AB1. The Q5 alpha for AB1 was still around 0.52% per month, and statistically significant, T3.8.
So even Q5 doesn't solve everything. There are still mysteries.
Absolutely. It suggests there are still nuances, maybe related to information diffusion or behavioral aspects in those immediate market reactions to earnings news that even sophisticated factor models don't fully capture yet. Progress, but not perfection.
Fair enough. But now let's turn to an area where Q5 apparently made huge strides. Accruals anomalies. Things like operating accruals and discretionary accruals. DAC-AC. These have always been puzzling, right? High accruals predict low returns.
Exactly. These were prime examples where the original Q-factor model showed large, significant negative alphas. Meaning it couldn't explain why high accrual firms underperformed so bad.
And in Q5,
Dramatic improvement. For operating accruals, OA, the original Q-factor alpha was MERA 0.57%, TDIS 4.25. The Q5 alpha plummeted to an insignificant MERA 0.20%, TDIS 1.30.
basically explain it away. What about discretionary accruals, DAC? That's often seen as even harder.
DAC was tougher, yes. Its Q-factor alpha was a very large NARA 0.74%, T-integer 5.33. Q5 significantly reduced this to NARA 0.31%, TDIS 2.16. Still technically significant at the 5% level, but a massive reduction in the unexplained portion.
Okay, so what's the economic story? How does the expected growth factor, Reg, achieve this? What's the intuition?
This is where it clicks beautifully. The key finding is that the high minus low portfolios for both OA and DAC had large negative loadings on the reg factor, loadings of NARA 0.56 and NARA 0.64 respectively.
Negative reg loading, meaning high accrual firms look like they have low expected growth.
Precisely. Think about what accruals represent. High accruals often mean reported earnings are high, but the actual cash flow generated is much lower. You're booking revenue before getting cash or delaying expense recognition.
So earnings look good, but the cash isn't there.
Right. And cash flow, as we saw with the COP predictor, is crucial for funding future investment and growth. So if a company has high earnings but low cash flow, i.e. high accruals, it signals lower capacity for future investment, hence lower expected growth.
And the reg factor picks this up.
Perfectly. It sees the high accruals, associates them with low expected growth, the negative loading, and correctly predicts lower future returns for these firms. The expected growth factor captures the economic mechanism. Low cash today implies low growth tomorrow. It explains the anomaly.
That's a fantastic aha moment. It connects accounting choices directly to future growth expectations.
What about other related anomalies like changes in working capital, DWC, or changes in financial assets, DFIN?
Similar story, significant progress here too. The high minus low portfolios for DWC and DFIN both had significant alphas under the original Q model. Under Q5, both became statistically insignificant.
And the intuition, does reg play a similar role? Yes. The DWC portfolio, high change in working capital, had a large negative reg loading, negative 0.52. This implies that big increases in net non-cash working capital, like inventory piling up or receivables growing faster than sales, might reflect past growth, but actually signal lower expected future growth because they tie up cash needed for future investment.
So again, a drain on future potential. What about DFIN?
The DFIN portfolio, high change in net financial assets, had a large positive reg loading, 0.40. This suggests that increases in financial assets, like holding more cash or marketable securities, provide internal funds that stimulate expected growth. The firm has more dry powder.
So reg captures both the negative signal from working capital buildup and the positive signal from building financial buffers, really nuanced.
It really gets at the underlying economic signals embedded in these balance sheet changes.
Okay, one more key example, the R&D to market RDM anomaly. This is a big one, related to intangibles. High R&D firms often look less profitable on paper but tend to outperform. How did Q5 handle this?
This is another major success story for Q5. It largely explains the RDM anomaly. The high minus low RDM decile, sorted annually, had a significant Q-factor alpha of 0.81%, T equal 3.64. Under Q5, this alpha was dramatically reduced to an insignificant 0.27%, T 1.24.
Explained away another major puzzle, and the intuition. It must connect back to how Reg handles R&D, right?
Absolutely. This is the flip side of the accrual story, and it highlights the power of including R&D in the COP measure used to forecast growth. As we discussed, R&D spending, due to accounting rules, depresses current reported earnings. It's treated as an expense.
Making R&D heavy firms look less profitable.
Right. But economically, R&D is an investment in future growth. It builds intangible capital knowledge, patents, processes that creates future opportunities. The original Q-factor model, focused on current profitability, ROE, and investment, i.e. using tangible assets, missed this crucial intangible aspect.
You can see the value being built.
Exactly. But the Q5 model, via the reg factor, which was built using forecasts incorporating R&D adjusted cash flows, sees it clearly. The high minus low RDM portfolio had a large positive loading on the reg factor, 0.84.
Positive loading, so high R&D signals, high expected growth.
Precisely. The model recognizes that high R&D spending, despite hurting current reported earnings, is a strong positive signal of expected future growth. It captures this economic mechanism perfectly, explaining why these R&D-heavy firms tend to have higher future returns. It resolves the apparent contradiction caused by accounting rules.
That's another fantastic aha moment. Seeing past the accounting to the underlying economics of intangible investment and future growth.
It really demonstrates the power of incorporating that forward-looking dynamic element.
Wow, okay. What an incredible journey we've taken today. We really dug deep into the world of financial factor models. We started with the solid foundation of the original Q-factor model.
Rooted in that static investment framework.
Right. And then we traced its evolution to this much more dynamic and powerful Q5 model, enriched by adding that crucial expected growth factor, Reg.
And we saw how meticulously that factor was constructed, using sophisticated forecasting based on observables like Tobin's Q, those carefully measured operating cash flows that crucially account for R&D and recent changes in profitability.
So what does this all boil down to? What's the main takeaway for you, the listener, trying to stay well-informed about finance?
I think the main takeaway is that the Q5 model represents a really significant leap forward, a major advancement in how we understand and potentially predict stock returns. By explicitly bringing in expected investment growth, it provides a much more complete, more accurate lens for viewing market dynamics.
And the proof is in the pudding, right? That massive reduction in unexplained anomalies.
Exactly. Dramatically cutting the number of unexplained puzzles from 52 down to just 23, and doing it with only one additional factor. That's huge. It's not just some minor academic tweak. It's powerful dimension reduction. It helps make sense of this vast, often bewildering landscape of financial data and market patterns.
And those specific examples really drive it home, thinking about how the expected growth factor helped us finally understand the counterintuitive performance of high accrual stocks.
Right. Seeing that less cash available for future growth signals lower returns.
Or how it illuminated why R&D heavy companies, the innovators, often deliver higher returns even if their current earnings look weak.
Because those current expenses are actually masking future growth potential hidden in intangible capital.
Those are the kinds of deep economic connections that this augmented model brings to the surface. It offers clearer, potentially more actionable insights into what's truly driving value creation over the long term.
And this deep dive really shows us something fundamental. Financial markets are undeniably complex, maybe even chaotic sometimes. But the relentless pursuit of understanding the underlying economic fundamentals, things like investment, profitability, and crucially expected growth, can lead to powerful new insights and better models.
It feels like as the sheer volume of financial data just keeps exploding, the ability to distill it, to filter it through fundamental drivers like expected growth becomes even more critical.
Absolutely. It's about separating the signal from the noise, discerning what truly matters for long-term value amidst all the short-term fluctuations.
So let's leave you with a final thought to mull over. A provocative question, maybe. Next time you're analyzing a company, look beyond its current state, its past track record, even its immediate profitability forecast. Ask yourself, what kind of future investment growth are you truly anticipating for this firm? How dynamic is its potential? And how might that forward-looking perspective, that expected growth trajectory, really shape its true long-term performance?
This research really nudges us all to think more dynamically, to look beyond the present snapshot and into the evolving, growth-driven future of a firm's potential. It's a richer, more complete way to think about value.